Happy New Year, everyone, and welcome to our Hordes Dairyman monthly webinar series. My name is Abby Bauer, and I'm an editor for Hordes Dairyman magazine. Thank you for joining us today for this webinar, which is titled The Dairy Price Situation and Outlook for 2023, a spotlight on demand, inflation, and regulation. Our presenter is Mark Stephenson, the former Director of Dairy Policy Analysis at the University of Wisconsin-Madison. As we begin this new year, the dairy industry is filled with both optimism and uncertainty, which is true for most years. Dr. Stephenson will lead us through some of the factors that will influence dairy prices in 2023 and share his predictions for the year ahead. This January kicks off the 13th year of our monthly webinar series, and we're thankful for all our dedicated listeners who have tuned into the program over that time period. All of our past webinars are available online at our archive at hordes.com. So if you want to check out any previous webinars, please visit that website. Our sponsor for this month's program is QLF, Quality Liquid Feeds, and we really thank them for supporting this educational program. If you're listening to the presentation live, you have access to a PDF copy of the slides. Just go to the handout section of the GoToWebinar control panel, and you should be able to find the handouts there. And you can also type in any questions you might have if you go to the questions section of the control panel and type them in, and we'll answer those following the presentation. Now it is my honor to introduce to you today's presenter. Mark Stephenson has recently retired from his position as the Director of Dairy Policy Analysis at the University of Wisconsin-Madison. In that role, Dr. Stephenson conducted and coordinated research and outreach activities related to the dairy industry. He continues to be involved in applied research at the firm and market levels, including costs of processing, spatial milk price relationships, trade, and price outlook. A native of Michigan, Dr. Stephenson received his bachelor's and master's degrees from Michigan State University in dairy science, and later a second master's and a PhD in agricultural economics at Cornell University. Dr. Stephenson, thank you for joining us, and I look forward to hearing your thoughts on milk prices, dairy markets, and more for 2023.
Well, thanks, Abby. I am happy to be joining the Hordes community again, and I'm actually happy to be joining it from northern Michigan. This makes the world small, I guess, to have the webinars, and nice to do it. This year, as you mentioned, is full of both hope, optimism, and some uncertainty. And so I do want to walk through some of that. And I'm going to do a little bit of a spotlight on some of the demand factors that I think are going to be important this year, including inflation. And also at the end, we'll talk maybe just a little bit about regulation and what changes we might expect to see over the course of this year. As I'm looking at some of the particular things in demand, I want to look at the impacts that inflation has had on our dairy purchases domestically. And maybe we can talk a little bit about the possibility of recession. I hate to raise that word, but it's one of the things that I think we have to be potentially aware of and be thinking about this next year. As far as the domestic supply is concerned for milk production, you know, it was a great milk price year. Let's just be straight out honest about it, all-time highs. On the other hand, we had very high costs of production, including feed, labor, and interest rates. We've also had in some parts of the country some very impactful weather trends, and we'll focus on just a couple of those things in a bit more detail. Export demand has been surprisingly good. We've also seen some shifts in the products that we're moving through exports. A good example is cheese being up a good bit, and something that I think we're going to be seeing more of. Export competition, though, we look at traditionally our strongest competition, like the European Union and Oceania, and we ask, what are they doing? What can they do? And then finally, we'll talk about some changes to federal milk price regulation. So let's get right in with it and look at demand. Now, this graph by its very nature is always like 1 year behind. So the last thing I can show you is 2021 on here, because it takes a full year before they assess how much consumption has happened across dairy products. At least this is the first place we get you know, good quality information. And this is a milk equivalent consumption for domestic dairy products here. So we look at all of our dairy products and say how much milk had that been equivalent to. And on a per capita basis, it's well over 660 pounds at this point in time. And 2021, despite the oddities that we've had of pandemic and post-pandemic and the beginnings of inflation toward the end of 2021, all the rest of it, it was still a good year. We had big increases. If you were to ask me though about right now, what's been happening, it's been different, through 2022. Inflation has taken its toll. If you look at just the dairy case for the first 11 months of 2022 with IRI data, we can see that consumers spent about 22% more dollars to purchase dairy products. Now that sounds like a good thing, but it was actually down almost 2% in product volume. Now that's not a big deal for the most part. In fact, I would call it a win at this point in time, because a 22% increase in the cost across the dairy case at retail is a big increase. And to essentially be flat on consumption is not a bad thing at all. So we'll have to gear up and look at this kind of a graph again next year and see what happens to total consumption in 2022 and the impacts of really big inflation on consumers. Again, going all the way back to 2021 and years prior to that, these are the categories where we've seen the most substantial growth. American cheese, other cheese categories actually been one of the biggest growth categories for us. Yogurt in most years has been a bit of a growth category since the mid 2000s. It had a kind of steady state over the last couple of years, but last year it grew again. And finally, butter. Looks like it's not much growth up there, but on a percentage basis, butter has been well up. So these are the product categories that have been something we want to salute. Fluid sales, however, have returned to being its depressing trend. Since 2010, we've not only had loss in per capita consumption. This graph is showing you total sales of fluid milk. So that's with increased population. In about 2010, we see this sharp decline that's been happening to our fluid milk sales. There was, during COVID times out there in 2020, a little blip upward. That was safer at home. People bought more milk and consumed it. So that was kind of a pleasant reversal of that trend, but it didn't last long. We're right back down on that line where we're seeing decreased sales of this product. And this is something I want you to just tuck away in the back of your mind here until we get toward the end of the slideshow and talk about what some of those implications might be. Let's think about milk supply for a moment. The purple line that we're seeing, it's up there in the top of this, was not this past year, 2022. This was actually 2021. So dairy cow numbers grew through the first quarter and more of 2021. They peaked out there during the flush, and then they began to decline. And of course, you might remember those really high feed costs and some sales that were challenging during that time period. So we began to whittle away at capacity to produce milk by taking dairy cows out of the US herd. This past year of 2022, that red line, shows you that we did increase a little bit. Those strong milk prices caused some positivity and a little bit of growth in our capacity, but that plateaued again when we get to the flush time period and has essentially been flat ever since. So our capacity to produce milk is above where it was at this same time last year, but certainly not at anything like our all-time highs out there a little bit earlier. Milk per cow also had modest growth out here, and you can see the trend where in the first half of the year we had almost no growth in milk per cow, but the second half of 2022 we have seen some growth. It's not explosive at all, but with high feed prices, I guess I wouldn't expect it to be, and we've at least been able to do enough to keep close to our normal trend, at least for the second half of the year, of growth in productivity. You put those things all together though, and what we see is a % change in milk production in this graphic. The first half of the year, close to it, we were in negative territory, actually losing milk production from year earlier levels. But we have increased. We're into the modest to normal growth territory of a little better than 1%, and we've been there. And if you take a look at the whole year overall, we're just essentially flat right now. I think that by the time we get our next milk production report that fills in December of 2022, we'll probably be looking at just slightly higher milk production in this past year than we had the year before, but certainly not big growth. Big milk price didn't stimulate a lot of milk production, a lot of milk growth, and that's largely because we were seeing pretty high costs of production, and we had some other constraints on milk production in some regions of the country, like supply management programs and a few other things that were impactful. So where did we see ups and downs? This is a map of the 24 states' milk production. They account for about 90% of total milk production in the US. So we've had 3 states that were pretty big gainers. That was Texas, Georgia, and finally South Dakota, that's just been going gangbusters. But other states, you know, like Iowa, have had substantial growth as well. Through that middle eastern portion of the country, the north there, Illinois, Indiana, Michigan, Ohio, Pennsylvania, all down. These are big milk producing states, and they've been down, as has Washington State. Big losers in milk production have been New Mexico and Florida. So when you take a look at the totality of milk production, it's been just about flat this year, but there have been some gainers and some losers, but the ups carry the day with just a little bit more production. Drought's still an issue. We've had a lot of headlines here in the last week or two of these atmospheric streams, you know, that have been pouring moisture from the Pacific Ocean into the West Coast and particularly up in the Northwest. But it's still going to be a problem, and drought is still an issue for the western half of the country. Partly we get these big rains when we've already had drought and we've got relatively bare soils, and that water is running back off into the rivers and out to the Pacific pretty quickly without getting fully captured. So I do think that dry conditions are likely to continue to be a problem unless we get longer, more persistent, gentler rains through the course of the year, and maybe a good snowpack up in the Sierras. But there's still a big portion of the country that's been dry, and I think it's been causing some recalculations or thoughts in milk production as to where long-term producers are really going to be and where they're producing milk. We've seen some herd sales out of large farms that have been surprising in the West. We're not used to seeing that kind of thing, but those herds and milk production are relocating to some of the areas like that. Texas has been a major growth area, as well as the I-29 corridor. So milk production's changing. Climate impacts are clearly part of the reason why. Components matter to manufacturing. And if you looked at a graph that went back over a much longer period of time, you would have seen that component levels have a seasonal up and down. You can see that certainly in these graphs of butterfat in the blue line and protein in the red line. But they were pretty flat, no real trend until you get to about 2010. And since 2010, we've had a substantial increase in milk components. Really quite astonishing. Part of that, of course, is genetics, and part of it is just better understanding of what a dairy cow needs in the way of feeding and management. But my gosh, we've had a US dairy herd that has averaged more than 4% butterfat in the past year. So that has really been up. And of course, the components are the things that matter when you're making cheese. Not as important under fluid milk, but you know, we certainly have been pushing component sales. Again, this will come back to maybe a little bit of the discussion at the tail end of the slides here, so keep that in mind. Exports have continued to be a very interesting category for the U.S. This chart is done on a rolling 12-month average, so it takes out some of the zigzags, the up and downs that we have. There's not as much of a seasonal component to exports or imports, but there's a lot of variability around the trends. So by giving you a 12-month rolling average, I think it makes these trends more visible. We've exported more dairy product last year than we ever have before, and our imports continue to be really pretty low. Clearly next net exporter, but we've got emphasis on some new products, and I'll show you that in the next slide or two. So exports are important, and we've now got a customer base that's so large and entrenched, about 18% of our milk production, that, you know, this is not just a pastime, not something we do as a hobby. Exports are real customers for us, and they're something that we have to pay attention to, and it can be very impactful for milk prices for us. This is a graphic out of the USDEC web page, and I think it helps us look at some of the individual products here and to see what has been up and what's been down. Most of our products have been up, but the one product that we export more than any other is non-fat dry milk and skim milk powder. And you may notice that in 2022, that was actually down a little bit. So those sales were not growing this past year, but you look at every other category and it's been growth. Particularly want to focus your attention on that cheese category. Now, cheese has almost been, as an export, a footnote for the U.S. until recent years, when this has picked up much more steady and larger volumes. And we've been selling a lot of cheese to a lot of new customers, and that's been a very good thing. I think this is going to be persistent and that we're going to see this happening. But this also has some implications for our milk price forecasts. Lactose picked up last year, and whey products did again, as the swine herds have been growing in China and other places. So those have been good sales for us. But butterfat, we've had a pretty big percent increase in sales of butter and anhydrous and other butterfat sources. But on a total volume basis, it still is what I would put in the asterisk or the footnote category for us. We've got competition for those exports, of course. U.S. is still kind of a young player in that, I would say, even though we've been doing this for, 20 years or thereabouts at this point in time. The U.S. line is shown in red, and that's the percent change in milk production in the U.S. We saw that in an earlier graphic, but I've also overlaid in here what the other major exporters, the European Union, what New Zealand, Australia, and a couple of other major exporters have done. And you'll notice that all of us, the US and other major exporters, had gone from the negative milk production, in other words, loss of milk production during the early part of 2022, to where we're back in positive territory. The US, again, up a little more than 1%. But so too are our competitors, now back in positive territory. There's been growth, particularly in the European Union. We've got some more competition for the sales of these products in different countries. Milk production struggled in the last year or so to provide really all the dairy product that the world wanted. This is a chart that's looking at the value of the US dollar against other major currencies from advanced foreign nations. In other words, our competitors out here for some of these sales. And when the dollar is strong, as it was during the early part of 2022, it makes it harder for us to export product, any product, whether it's dairy or something else, because our products have to look more expensive next to those from countries with weaker currencies. But in the last half a year or so, you'll notice clear at the right-hand side of that graph, our dollar value has been weakening somewhat, and that's a good thing for exports. So this is helping to improve, I think, the export outlook for dairy products in the year ahead, especially if this continues to happen. Our U.S. dairy powder prices, that's non-fat and skim milk powders, are tending to always be competitive. And the reason is that we export more than half of that product, sometimes up to 80% of what we make in this country gets exported of powder, milk powder. And so we are often the ones that are setting the price trend out there, the red line in here, which is the lower price. But you'll notice clear over on the right-hand side of this chart that the U.S. is not the low price at this point in time. New Zealand is lower right now, and even the European Union as major sources of milk powder are lower. We're just about at or slightly above those. We're only less than South American sources of powder are in the marketplace. So we aren't as competitive, which tells me there's probably going to be more downward pressure on powder prices over the next several months. When you look at cheese prices, we're not often very competitive there, but we have been for the last 2 years. We are selling cheese, and that's part of why cheese exports have been increasing, is that our sales prices are competitive out here and moving product along. I think going forward, cheese has been, in the past at least, has been a bit more of a well, we sell it when we can kind of opportunity. But as we begin to manufacture more and more cheese in this country, I do think that it's going to become more and more like the skim milk powder has been for us. In other words, our markets are going to have to clear through exports. We're going to have to be a regular player, if not the most competitive player in that marketplace. And we've got quite a bit more cheese capacity that's coming online this year and next year. Some of those on the books being planned, you know, in West Texas and Nebraska, and a little bit further in the Southwest, some additional areas with more cheese capacity. As that comes online, that's not all for domestic use. It's also going to be sold overseas. So cheese is going to be more regularly competitive. Butter, we are currently not very competitive with butter prices. Oceania is much lower than we are now. We did sell, and you can see that in this graphic with the red line below everybody else, where our butter prices were competitive until 6 months or so ago. And now they aren't as competitive, and we aren't moving as much product. So who knows where butter goes, but right now, not so competitive. Let's shift gears a little bit. I want to talk about the U.S. macroeconomy, because I think this is part of the clue for what is really going to be milk and dairy product prices in the year ahead. We all know about inflation. My gosh, that's been a major headline for us now for the better part of a year. And inflation has been up in that 7-8% range for quite a period of time. In the last few months, we have noticed that the Fed's activities seems to be putting a little bit of the brakes on inflation, but it's still well above where they would like it to be, in that 2 to 3% range. We're still up around 7%, but the trend is at least better. We've turned a corner. It's a difficult thing to try to steer this ship, and I think the Fed does what they can with tools that are fairly crude, actually, to manage this kind of thing. But inflation has been really challenging consumers and producers. I didn't put it on here, but this is the consumer price index, the CPI. It's what buyers of final products are facing on a regular basis. This certainly includes the price of butter and eggs and green products in grocery stores and other things. But there is also a PPI, a producer's price index. And those are the kind of input costs that manufacturers are facing. And the PPI has been well above the consumer price index for quite a few months, which is what really suggested to me that that's got to work its way through sales, and that the CPI would continue to have this inflationary trend, which it did. But now the producer price index has been coming back down a little bit, and I think it indicates that both of these things, both consumers and manufacturers, are beginning to see a little bit of relief in the growth, at least, of these prices. We've been meeting or accommodating inflation at partially the expense of savings. This graphic is showing you the personal savings rate in this country. So of your domestic dispendable income, how much of it are you saving versus how much of it are you using to consume goods or buy things? Well, you can see this unbelievably historic peak that we had back in COVID times, our safer at home, when we were up in the 30% savings. That was because we couldn't really spend money very easily. We couldn't go anywhere to do anything. We couldn't eat out or travel. But we're doing that again now. And, you know, it's been normal, historic for us to save, 6, 7, 8% of our disposable income. And you'll notice that now this is whittled down to the 2% range. This is something that gets to be a little bit alarming. If we can't save something, this impacts us long term if we don't have enough to retire on. So our savings rate is really pretty important. We're accommodating the greater costs of inflation at retail by not being able to put as much away into savings. There's another thing that gives us pause too this year. You can look at such things as the treasury rates on bonds and over different periods of time. So if I were to buy a bond that would mature in, say, 3 months or a year or 2 years, that's relatively nearby. And generally speaking, we don't have very high interest rates on those because we have a pretty good idea about what those next few months or even year or so is going to look like. But generally speaking, we have to be compensated if we are going to purchase and hold a bond for, let's say 10 years, a much longer horizon. This is where the time rate of money gets to be part of the equation for this. And we expect a yield curve on a bond to show that over time it's upward sloping. So the longer the maturity on a bond, the higher the interest rate should be that you expect to have. If you look at two things together, like a short-term bond and a long-term bond, and they become inverted, that means that our short-term interest rates are actually higher than our long-term interest rates, which is usually an indication that investors are concerned about the future. And the reason I'm giving you this graph and pointing to it is that you notice that dark line at the 0 mark going across there. Well, anything that's below that is what we call inverted. In other words, our short-term interest rates are higher than long-term interest rates. And all of our last 7 all of our 7 last recessions are shown in those gray columns that we have here on the graph, the bars. And every single one of them was predated by an inverted yield curve. So this is basically the wisdom of the crowd saying, I'm pretty concerned about the future, and they seldom have a wrong answer about this. Usually this inversion happens almost a year before we declare an actual recession. So you'll notice clear at the right-hand side where we are, we're in pretty inverted territory right now. And I think it suggests to me that I'm kind of concerned as we get out toward the end of the year that we may not, or that we may well have a recession on our hands. Recession is different than inflation. Consumers behave differently under recession than they do inflation. So we've got a little bit of both. And this is not to say we absolutely are going to have recession, but it makes me more concerned that this is something we're going to have to deal with by the time we get partway through the year. We've all become aware, I think, of the Global Dairy Trade Index. This is an auction that occurs bi-weekly. Fonterra, as a company, has helped sponsor this, and New Zealand runs the auction. But there are other, like US, who are members and trade product on this. But it provides for the world an opportunity to buy or to sell some dairy products, and it provides an opportunity to see what the indication is on a world trade index, the interest is in those dairy products. Now, you'll notice here, this blue line back in early part of 2022 was very high, in fact, at historic high levels. But it's been on the downtrend here now for a period of time. And we're now back in that territory where we had seen prices during that 27 through 2019 time period. So dairy product prices are now actually trading on world market down at that 2017 to 2019 range. And that's something I want to draw your attention to. Let's take a look at milk prices and what that time period was like back then. Again, this relates to dairy product values back to farm milk prices. Here is that time period I've shown in gray for 2017 through 2019. And you'll notice that this last year, clear on the right-hand side, we've had all milk prices here in the US in that $25, $26, $27 range. They've been very high, even though our costs have been elevated. But back in 2017 through 2019, the all milk price in the US was more like $17, $18, $19. So, this is that kind of intersection that we just saw with the global dairy trade. And it should indicate to us that our domestic prices have quite a ways to fall if we're going to be competitive selling dairy products on the world market. And I think at 18% of our milk supply, we have to be. So what's my forecast? Here I'm showing you in the solid lines. Solid blue line is class 3 price, solid green line is the US all milk price, and the solid red line is the class 4 price. And clear over on the right hand side, I've got some dashed lines there. Those are based on the current Chicago Mercantile Exchange future prices for class 3, class 4, and my interpretation or calculation of what the US all milk price is or would be. Now you'll kind of notice here on that all milk price that is ranging up there in that $20 to $21 range for US all milk over this next year. And again, I've thrown that kind of pink bar on there that would suggest where the GDT thinks these prices maybe ought to be. And it's grumpier than the futures market is right now. So I think you have to take a look at what futures markets are trying to tell us and what maybe global dairy trade is trying to tell us if we're going to be a player in those export markets. So here's my summary on things. Our domestic demand has held up surprisingly well in the face of inflation, but I think we've also got some other things that are suggesting that that's going to be difficult to continue. Consumers have bought this year's worth of inflation out of their savings and with credit cards, and that's not a good long-term strategy. That's something that we are going to have to see corrected because we just simply can't continue to do that. I'm concerned about this probability of recession this next year. What will the consumer's strategy be under that kind of scenario? Recession may mean that jobs are harder to come by, and that inflation is going to be even harder to accommodate. Milk production this past year has been cautious. We've had pretty good milk prices, but the costs have been high and nobody's been jumping out there to really expand milk production greatly, with the exception of what we've seen within 2 or 3 of our growthy states here. But there's new plant capacity that I told you about that's being planned and will be coming on board. And as that's the case, it has implications for milk production, at least in those areas, and the products that will be produced and served. And that has implications for our total US milk prices. Those high milk prices have yielded decent margins, but I'm not sure the same thing is going to be the case in 2023. Some producers were having a difficult enough time with high labor or just being able to access labor if they needed it, with high fuel costs, with high feed costs. And I think if we have milk prices that are going to be considerably lower this next year, that we now have quite a few farms that may be in difficulty. Our futures market prices would suggest right now that maybe about $4.50 would come off of a farm milk price. If you look at that global dairy trade comparison, maybe as much as $5.50 will come off of that. Let's just take the midpoint and say $5 is likely to be the kind of decline that we see in our farm milk prices in the year ahead. So it's going to be all of the costs that we've had to produce milk with much less income. Now let's just talk about a few possibilities for regulatory changes. We do use product price formulas, which means that in our federal milk marketing orders, we want to price milk, farm milk, and this is a possible ingredient and product stream in a cheese plant. A few of our endpoint products would be like cheese, dried whey, or butter, and those are three products that we do survey and collect data on weekly. Those product prices become the imputation of our farm milk price that gets regulated in federal orders. And this is what we have with product price formulas. We take that butter price as an example, minus something we call a make allowance, and that's really an estimation of what it costs to transform milk into a pound of butter. This formula right here would say 17 cents or thereabouts. And a yield factor. How many pounds of butter can you make from 1 pound of butter fat? About 1.2. That make allowance has not been changed since 2008, I think was the last time we looked at make allowances, and plants are really getting squeezed. And we are going to have to see a change in the make allowance. But that also means that there's going to be an impact on farm milk prices if we do that. Dairy producers basically want a small make allowance and a big yield factor because that gives them the biggest milk price they can get. Dairy processors want a big make allowance and small yield factors because that gives them the lower cost on their purchase of milk. So what are the correct parameter values? That will have to be sussed out in a federal order hearing. The make allowances, in my opinion, though, are not status quo. They must be changed. Plants are really having a difficulty, and many of them are deregulating or depooling milk as a result of that. So if that happens and it puts downward pressure on farm milk prices, dairy producers are going to want to offset that somewhere. That could be from lower regulated prices in the marketplace. They might look for an increase in Class 1 differentials. That's certainly been under discussion with folks. That puts a burden on fluid milk. And of course, if you remember our graphic on fluid milk sales, that's already a bit of a sore-footed horse, I think. So Class 1 differentials is a difficult place to look for all of that relief that producers will want. They might also want to walk back this change that we made a few years ago from the higher of Class 3 or 4 for Class 1 prices to the average of plus 74 cents. If we do that, that will increase prices again on Class 1 milk. It puts the burden there on fluid. So that's two things that would say we're going to try to pay for make allowances with Class 1 milk. And I've also heard folks talking about wanting to update the component values that I talked about. Gosh, our standard milk in federal milk marketing orders is 3.5% butter fat when we've been averaging over 4% in the US. Sounds like an innocent thing, but it won't have an impact on manufacturing milk because you're already getting paid for the pounds of components that you sell. But under our formulas that we have that are generating fluid milk prices, there's a thing called skim milk pricing factors that would be where this gets updated. And again, the impact falls on as a burden under fluid milk. So here are three things that would be a heavier load for class 1 to carry in order to accommodate the make allowances. That's going to be a difficult sell, I think, too. So just some observation, this classified pricing and pooling we have are blunt tools in an increasingly sophisticated marketplace. The negative PPDs that we've seen over the last couple of years weren't really the problem. I mean, it may have felt like a problem, but I think they're more like a symptom. The problem was there wasn't enough money in the pools to be interesting to stay in them. So it's like going to your doctor and saying, I've got a fever. Well, the fever's not the problem. The problem is something that's causing the fever. So we need to determine what it is. We'll have a federal order hearing and probably this year in 2023. I don't know when, but we'll certainly have some kind of announcement about that. And then we'll be able to see what the parameters of that hearing are going to be. One of the big questions is, what's the scope of the hearing? What is it that we're allowed to talk about in the way of changes? Is it going to be fairly broad? You know, can we look at lots of different things like pooling requirements, or will it be tightly focused on just something like the make allowance? I have no real insights there. That's something we'll have to look at and see. So the next question is, you know, whether or not we can fix the problems that we perceive in the dairy industry with a federal order hearing, or will some of it require congressional action? I think a lot of folks that I hear talking about, well, we need to have a federal order hearing to fix X, Y, and Z, are talking about things that can't be done through the language that makes federal orders even available to us. They would have to come from changes that Congress would make. And, you know, I hate to say it, but in this last week or so, a term like congressional action might be an oxymoron. Boy, there are going to be so many fights that we have in Congress this next year that I'm not sure what gets accomplished. This is a farm bill year for us to be gearing up to do. That may be hard because they'll be looking at big spend categories like, you know, food programs under the farm bill. We will have to raise the debt ceiling, and that will be a big issue. And if that doesn't get passed, that will almost certainly push us into recessionary time period. So those are a couple of my observations, I guess, I have about that. And with that, I guess, Abby, I would be happy to stop sharing my screen and or maybe move forward for you and go into a question time period.
Yes, absolutely. If you want to move ahead one slide, thank you. So thank you, Dr. Stephenson, for sharing your insight and predictions for the dairy industry in 2023. There's certainly many moving parts that factor into the forecast, and I appreciate you taking a swing at speculating what might be coming down our dairy pipeline in the year ahead. Once again, we do post all of our webinars online at our website at hordes.com, and this presentation will be available later this week. So if you're interested in rewatching it or want to share it with anybody else, please check out our website later in the week and you will find the webinar there. We also hope that you'll make plans to attend some of our future webinars in 2023. Our next webinar will be in February. If you go, there you go, on the 13th. And we will have Dr. Amelia Willems from Mississippi State University talking to us about immunity in dairy heifer or dairy calves. And that webinar will be sponsored by Caftel. And then in March, we'll have Mike Hutchins, a familiar voice to our webinars, from the University of Illinois. He'll be here to talk about boosting milk components, and that webinar will also be sponsored by QLF, just as they have sponsored this particular webinar. So we thank them for their support. Now I want to remind everyone that you can type in your questions. We have a few that have come in, so we'll start answering those now. But if you want to ask Dr. Stephenson anything about the presentation or milk policy or pricing in general, feel free to type those questions in and we will answer them as we go. So Dr. Stephenson, the first question, you shared a slide that showed a graph of the decrease in liquid fluid milk sales. How big of a threat do you think almond or oat beverages are moving forward, that alternative beverage space, and how it competes with milk?
Well, that's they've certainly been part of the story behind loss of sales, but I think we have to look at this a bit more broadly. We can't place all of the blame on those competitive beverages that we've had. And if you want to take a look at just this past year and the IRI data, I think it's been interesting to see that inflation has had a bigger impact on the sales of milk alternatives in a negative way than it has on our beverage milk. We're down about 2%. And if I can remember correctly, I think that those alternative dairy beverages or non-milk beverages were down about 7 or 8% in volume. So they've taken a bigger hit than milk itself has. So they're part of the issue, but we just have change in consumer preferences and tastes. We're still, remember, consuming more milk equivalent dairy products, but we're eating our milk more than we're drinking it. So that's been a bit of a problem for us. It's not just that we've switched to plant-based milks. We have switched, in fact, to not just consuming as much of that type of product.
Okay. I do have a shout out here, someone welcoming you to Northern Michigan. So go green. Just want to get that in there. Next question, any thoughts on what the organic milk market will do in 2023?
Oh boy, the organic market is one of those things that I've tried to gear up on and look at more intensively from time to time, but I don't do it continuously. And honestly, I'm not sure that I have, very good insights about that right now. If we look in the past, though, at some of our recessionary time periods, we saw a lot of pressure on organic products as people maybe slid backward a little bit, trying to find some relief in prices. They haven't given up on the category, but they've maybe purchased the organic milk for the children and maybe more conventional milk for the rest of the family as a means of savings a little bit of income on it. So that would be one of the places where I think we need to be concerned in these kind of times of both inflationary prices at retail, but also of the possibility of recession coming up.
Thank you for that. This question, not sure how closely you follow these markets, but just someone wondering if feed and fertilizer will get any less expensive in this year. And do you have any recommendations on taking a position on any of those commodities as it relates to milk production and milk prices?
Yeah, that's just easy for me to say. I'm not even standing at that plate. So I'm not going to try to take a swing at that ball. Yeah, no, this would be for another speaker, I think, to talk about input prices. And just generally, obviously, we've had a lot of pressure on these things. And boy, fertilizer prices, of course, are so tied to fuel markets and, war in Ukraine and just a number of other things. That will be for somebody else to talk about.
Understandable. So many different trends to be watching. So a question came in wondering, they want to know more about the Dairy Revenue Protection Program. Maybe, I know that could be a whole webinar in itself, I imagine, but maybe you could just do a few moments explaining that program a little bit and what it's designed to insure against.
Sure. Dairy Revenue Protection is a program that was brought to the dairy industry a few years ago, and it lets you look at least 1 quarter ahead and up to 5 quarters ahead to protect your position. And you can make a decision about the kind of milk prices that you face, whether they're more influenced by class 3 or class 4. So you can look at the kind of blend that you would receive of those prices. It's a nice product, and I think that the best way to look at it or to think about it is that it's a subsidized, like purchasing a subsidized put. So it is a pretty good price and product to use. The one problem that some folks would have is that these are always going to be at least 1 quarter out. So you can't protect prices in the quarter that you're currently in. But it is a very useful risk management product and something that you might want to look at now. So just as a good example, I was talking about how I think that futures markets right now for class 3 and 4 are maybe even a little more optimistic than something like the global dairy trade index it would suggest. So I think that what that tells me is there's probably more downside potential in futures markets, even though we don't think them to be biased at all. There's no tendency for them to be high or low. I think, this is my personal observation, that there's probably more downside potential right now than upside, which would suggest get out there, and while we still have time, even with things like the dairy margin coverage program, if you haven't signed up yet, please go and sign up. We are projecting almost 100% certainty at this point in time that a 950 level of protection under tier 1 will be a positive return on investment.
Thank you for offering that advice and overview of the programs. A little bit of a different question here. What do you think the impact of the beef on dairy trend will be on dairy cow numbers? Just how, if that impacts the expansion of the herd and heifer prices moving forward?
Sure. I think that as it gets more and more incorporated as a standard practice for us, we'll find a better equilibrium than we've had in the past. It's been very intriguing alternative. We know how expensive it is to raise heifers. And we used to raise all heifers a little while ago, and then it became pretty clear that that was not maybe an optimal strategy in the long run because it's expensive to do that. So we need to think a little bit about what animals in our herd we can afford to breed to beef and maybe raise that way, or sell them as beef animals. And in so doing, I believe we had a period of time when maybe we had a little bit of a surge that put so many of those animals into the beef herd potentially that we didn't have as many heifers available to react to a market price that said we need more milk, at least as quickly and easily as we used to do in the past. But I'm quite sure that going forward, those markets will equilibrate, will begin to plan a little more easily about what percentage of our herd should be going as beef animals. It's a good trend and something that I think we ought to be using more of as a tool.
This question is more focused on products again. This person says they've noticed at their location in Ohio that several dairy products have been in short supply in the past month or so. Examples like butter, whole milk. I mean, we've all heard people saying they are seeing empty shelves at stores here and there. Any idea why, if this is like a regional supply shortage, or what could be the cause of these empty shelves?
Yeah, I don't think that this is anything systemic like we saw 2 or 3 years ago in store shelves, but I've also noticed in our grocery stores that periodically there are products, and it may seem a little bit strange, that are just not there on the shelf, and that has to be just continued hiccups in our supply chains. We've had a very well-functioning supply chain for a long period of time, as long as there wasn't a big disruption to it. COVID was a huge disruption, and it's just shaken the supply chain from one end to the other. And it's taken a long time for us to be able to kind of get back in sync. I don't know what the problems may be that somebody was talking about. It could be anything from packaging shortage to just not as much milk available for a plant for the particular products they were producing. but we have seen some stock outs in local stores, but it's nothing that's broadly spread or being talked about very much right now.
Okay. Do you have any comments about the global impact that China's recent growth in milk production has had or could have in the coming years?
Could you just re-ask that or rephrase it? You're asking about the growth in China's milk production and what impact that may have?
Yes, globally.
Okay. China certainly has been working hard to try to increase their milk production over quite a few years. I've been to China a couple of times and have seen, some of the production that we've seen on dairy farms there. They've done a great deal of investment in equipment and practices and manufacturing to try to increase milk productivity on those farms. But same genetics that they purchased from North America, same stainless steel that they may have purchased from Europe or somewhere else that we're using in some of our plants and things. And milk productivity per cow may be more like 10,000 pounds instead of 20,000 pounds. And you can scratch your head a little bit, but I think that when you see the full system over there, it's been understandable why those kind of lags in production have been occurring. They may be getting over some of that now and being able to increase productivity a little bit more. They may have more access to feed than they did earlier and working at expanding the dairy herd a bit, but there's no question that that's been an objective of China to produce more of their own feed, whether on their domestic soil or on other soils around the other countries. But I also note that some of the purchases that they've made of dairy farms or processing operations in other countries, they've been selling more recently. So more of that, I think, has been coming home than going out.
Someone is suggesting or asking, could part of the explanation for the reduced powder exports in 2022 be due to a decrease in domestic powder production?
I think the answer to that is yes. I don't think there's any doubt about that. Most of our powder production has happened on the West Coast. And boy, the West Coast has been hammered with all kinds of things from just weather and environment to price relationships. I mean, high feed prices out there relative to the milk prices that they've had available. But milk production has been down to flat in many of our milk producing states like California, and not as much milk produced and ready to go to powder plants in that region. So that's been a problem. Washington State, another place, you notice that was a state that's been down quite a bit in milk production in this past year, another big milk or powder producing state. So some of it has been milk related and some of it's probably been price related as well. I noted that even though we haven't been selling as much, our prices are not as competitive right now for powder as some of the other powder producing regions of the world.
Okay. Our next question says, to meet the future world demand for dairy products, and because other countries like the EU and Oceania have limitations based on land, weather, regulation, this person said they've heard an expert suggest that the US will export 25% of its milk sometime down the road here. What do you think? And do you think that number is possible?
I think that's an entirely possible number. And you're correct that a lot of the large milk producing countries that we've thought of as being our big competitors, those things that we've been trying to crack, are facing hurdles that are not just are pushing them hard, in these marketplaces. But a good example, New Zealand has been facing probably too many animals on too small a footprint. And they are a very environmentally sensitive country, and they've been talking, more and more about just, how much dairy can we host on our soils and waterways and lands. So there have been some real restrictions that have been discussed and are being implemented down there that are going to be difficult to increase milk production as they have over the last few decades. Same kind of thing is true in the European Union. Now that's a big place, so it's not like you can say all of the EU is under pressure, but there are many countries that are very much under pressure. Take the Netherlands as a good example. Phosphorus limitations have made it difficult to produce the kind of milk and the growth that they've had. We saw tremendous growth out of a country like Ireland over the last decade, but they too have just about hit the wall in terms of the animal bearing capacity on a pasture-based system. So it's going to be difficult for many of those traditional milk producing regions to continue to have the growth that they've had in the past. I do think that as the world wants more dairy products, increasingly we have an opportunity to sell more. So we've got a lot of resources that, if carefully ushered, will be able to do that.
Okay, we have a question that is geared more towards the EU. It says, what do you think the effects of the EU's Green Deal, how that will impact agriculture? Any thoughts on that?
Well, yeah, I mean, it has a variety of impacts. We've talked a little bit about some of those and some of the country level impacts. But, this was a startling thing to me too. They want to produce more of their energy from biosources if they can. In no small part, I think, because of the conflict in Ukraine, showing them how vulnerable they can be to energy crisis. But that comes at a cost. I was really quite surprised years ago when I was in Germany first, and to see relatively small dairy farms that had digesters on them, because it was the sale of electricity or methane that was really being supportive of a dairy that was about breaking even. And they would scoop corn silage up out of the bunker and bring it over and dump it right straight into the digester, rather than processing just the manure from the dairy animals. And, that tells you a little bit about what, green policies may do for folks. I think that it makes it more and more difficult, both from the push side as well as the pull side of a demand to be greener and more environmentally friendly across the board.
Very good. And our final question here, you talked some about the impending farm bill. This person's just wondering, do you think the farm bill will influence dairy prices in 2023?
I don't think so. First of all, the farm bill has to be debated and passed. What are the big pieces that could influence it, I suppose? I don't think we've got a real beating problem now. Most of those problems have been fixed in something like the dairy margin coverage program, so not a lot to even be brought to the table there. And there may be a few things where we look at whether or not federal order regulations could be released or be considered, would need to have congressional approval to do that. That could be a possibility, but that won't happen in 2023. This is a long, slow process of passing that farm bill, and probably the bigger impacts potentially on a farm bill would come through the food programs, much bigger spend, and long-term more of an impact on us for the products we produce.
Absolutely, something coming down the road. But thank you very much, Dr. Stephenson, for taking the time to answer that variety of questions that came in. I think it just helps add a little bit more following the presentation and being being able to answer questions that are on people's minds. So really appreciate that. Once again, I want to thank QLF for sponsoring this webinar. We really appreciate their support of our educational program. If you want to learn more about their company, feel free to look them up online. I also want to thank my teammates, Patty and Michaela, for all their work in producing and promoting these webinars. And as always, I want to thank all of our audience listeners, all of you who are listening live, and then all the people that join in on the archives later on. We really appreciate you taking time to listen to these programs, and we hope that you find value in them that you can take back to your dairies or the dairy farms that you work with. So once again, Happy New Year to everyone who is online. And we really are glad that you were able to join us, and we look forward to hosting you for a future webinar. Until then, goodbye from all of us here at Hordes Dairymen, and please take care.